Hi, I'm Julie and this channel's Happy on Monday. Somebody asked me the other day, why did I name my channel Happy on Monday? It's a saying about retirement. When you don't have to get up on Monday mornings and go to your 9-to-5 job, people that are retired are happy on Mondays. So that's where my channel name came from. In this video, I'm going to talk about the retirement bucket strategy. There are so many versions of the bucket strategy out there, and they're all a little different. I'm going to attempt to explain what the bucket strategy is with my own spin. The retirement bucket strategy is an investment approach that separates your retirement income into 3 buckets. Each of these buckets has a specific purpose based on when you need the money. Bucket number 1 is immediate or short term. Bucket number 2 is intermediate or mid-term. And bucket number 3 is long term. This approach withstands short-term dips in the market to prevent you from having to sell low to cover monthly expenses. The idea behind this strategy is that you'll have access to cash in the short term, so you won't have to worry about fluctuations in the stock market. With the last few years of stock market craziness, this approach really appeals to me. In theory, you shouldn't have to sell your investments in a down market to fund your annual withdrawals. It helps to control emotions during stock market volatility. And I tend to be very emotional about the stock market. Your annual withdrawals are made from bucket number 1. This bucket is funded with a combination of safe investments. This would be cash reserves and other investments that are less affected by the market. The buckets are refilled with interest income, dividends, and the performance of your investments. When the stock market is down, you can rely on cash. When the market is up, you could draw from bucket 2 or bucket 3. Some of bucket 2 and 3 will also be used to replenish bucket number 1. That way, you're ready for a downturn in the market, at which time you can take from bucket number 1, the cash bucket. If you're relying on your nest egg to provide income for decades, you want to be careful about how you manage your assets. Market volatility in the short term could majorly disrupt your financial health if most of your money is tied up in investment accounts. You could be stuck selling investments at a loss to cover your immediate income needs. No! So this is why people like the bucket strategy. Bucket number 1 is the short-term bucket. Liquidity and low risk are bucket number 1. Cash and other liquid investments are in this bucket. These investments may include cash, high-yield savings, T-bills, CDs, money market accounts, short-term treasury bonds, and other assets like this. You want this bucket to be liquid, meaning it's easily converted into cash. While earning interest on this money is appealing, the main idea is that you're reducing risk and ensuring that the money is there when you need it. This really appeals to a worrier like me. You want enough cash in bucket number 1 to cover, some people think 1 to 3 years. I'm personally more comfortable with 4 years worth of expenses. If you have any guaranteed income sources, you can include those in this bucket, like Social Security, pensions, annuities. To create the first bucket, calculate your yearly expenses and then add in some extra money for an emergency fund. Create a projection of your expenses over the next several years, factoring in inflation and any one-time events like buying a car or paying for a wedding. When this bucket starts running low, the idea is to replenish it from dividends and interest income and investment returns from your other 2 buckets. The short-term bucket is all about liquidity. It should allow you to meet your income needs without worrying about what's going on in the market. Bucket number 2 is the mid-term bucket. This second bucket has lower risk investments. You might have a mix of bonds and income-focused equities. This middle bucket covers expenses from year 4 to year 10 or something like that. Money in bucket number 2 should continue to grow and keep up with inflation. However, you want to avoid high-risk investing in this bucket. This bucket is funded with medium-risk investments. This is where 50% or so of your nest egg sits to keep pace with inflation. It earns 5 to 10% growth when the market does well. When the market doesn't do well, the goal is that these investments don't take a big loss. This bucket is looking 10 to 12 years into retirement. It's making sure that there's money there. Its function is to create both income and stability. The risk level here is medium. Playing it safe can make it difficult to keep up with inflation, but being too risky could result in losses. Ideal assets may include longer-term CDs, longer-term bonds, preferred stocks, convertible bonds, growth and income funds, utility stocks, and more. Returns generated from this bucket can be used to refill your bucket number 1 as needed. Bucket number 3 is the long-term bucket. This bucket can be focused on growth because it has the longest time horizon. This bucket should have 15 plus years worth of income in it. These investments grow your nest egg more than inflation. It also allows you to refill buckets 1 and 2. The long-term bucket investments are invested in more risky things. They may be volatile in the short term, but they have longer-term growth potential. This is over 10 years or more. The third bucket is positioned for long-term growth. This is the bucket that must outpace inflation. It includes a percentage of your portfolio that could be lost if the market takes a downturn. Eek! This bucket is designed to allow you to catch the 15 to 20% growth while assuming 100% risk if the market crashes. This is a hard one for me. With the retirement bucket strategy, your long-term bucket should have a diversified portfolio of stocks and related assets. It should be allocated across domestic and international investments. This bucket may include stocks, high-yield bonds, real estate, and other high-return assets. Devoted to growth, this bucket is for high-risk investments. These will help you beat inflation over the long haul. This means volatile assets that are likely to go up and down. They go up and down in the short term, but hopefully earn significant returns over the next decade and beyond. As income is generated from these investments, you can top off your other 2 buckets, especially when the market is doing well. I'm including a link below for the Retirement Manifesto guy's bucket strategy spreadsheet. Everything this guy has is fantastic. Here's a glance at what I would loosely like my buckets to look like when I retire, and I'm not there yet. Bucket number 1, I would like to have $150,000 with high-yield savings, CDs, and I-bonds. Bucket number 2, I would like to have $200,000 in with conservative IRAs and mutual funds, and also a conservative Roth account. Bucket number 3, I'm hoping to have $150,000 of less conservative IRAs and a less conservative Roth account. So the benefits of the bucket strategy are that it protects you against market volatility, it leaves room for growth, and it organizes your portfolio. Drawbacks of this strategy are it may not align with your investment style, and you'll need to rebalance as needed. The retirement bucket strategy is one way to manage your income when you're no longer working. If the style vibes with you, it can provide stability and allow you to grow your portfolio during retirement. Rebalancing your portfolio at least once a year is recommended. This is something I think I could do on my own, although I may still hire a fee-only financial planner sometime in the future. Now I have a joke. What did bucket number 2 say to bucket number 1 after a market downturn? You look a little pale. If you're interested in retiring early, consider subscribing to my channel. This is what almost all of my videos are going to be about. We can totally do this. Leave a comment below if you want to share how you feel about the bucket strategy. Thanks for watching. If you found this helpful, please like and subscribe. I'm going to leave you with the quote, "Don't cry over the past, it's gone. Don't stress over the future, it hasn't arrived. Live in the present and make it beautiful." Hope to see you again soon.